Investor ratios. The returns to an investor is dividends. Hence, the ratios related to dividends, profits, shares are important. For a debt investor, they will be interested in interest yield ratio. Number 1. EPS is equal to profit after interest, tax, and preference dividends divided by number of shares. Number 2. PE is equal to share price divided by EPS. Number 3. Dividend per share is equal to total ordinary dividend divided by total number of shares. Number 4. Dividend cover is equal to profit after tax divided by dividend for the year. Number 5. Dividend yield is equal to dividend per share divided by market share price. Number 6. PE ratio multiplied by dividend cover is equal to 1 divided by dividend yield. Number 7. 1 divided by PE ratio multiplied by dividend payout ratio is equal to dividend yield. Number 8. Total shareholder return is equal to DPS plus change in share price divided by share price at period start. Number 9. Interest yield is equal to interest divided by market value of debt. Limitation of ratio analysis in identifying financial distress. Number 1. Ratios are only good indicators of performance in the short term. Number 2. Ratios give an indication of the situation at a given point in time, but do not determine whether the situation is improving or deteriorating. Number 3. The ratios obtained can be interpreted in multiple ways, and hence ratios don't lead to a single definite understanding. Practical issues of financial distress. Though ratio analysis does give an indication of financial distress, considering its drawbacks, some other practical indications of financial distress are as follows. Number 1. Huge amounts of debt and major debt repayment pending. Number 2. External finance necessary to continue existence because of falling profits. Number 3. Inability to cover interest payments. Number 4. No dividend payment for long periods and falling share prices. Number 5. High outflows and inflows, worsening cash flow. Number 6. Poor liquidity position and inability to raise short-term finance. Number 7. Poor credit rating and inability to raise loans at normal rates. Number 8. Inability to comply with loan terms and covenant breached. Number 9. Suppliers cutting off supplies due to delayed payments. Number 10. Loss of key management and skills. Number 11. Outdated technology and product lines. Number 12. Failure in staff retention. Number 13. Loss of competitive position and market share. Number 14. Huge fines or penalties due to regulatory non-compliance. Number 15. Huge fines or penalties due to environmental damage. Number 16. High amount of contingent liabilities. Number 17. Ongoing legal cases that are showing major signs of failure and going concern issues. Corporate reconstruction. When companies are moving towards a failure, a corporate reconstruction is done in such a manner that it remains in the business, then get liquidated. The corporate reconstruction method for solvent and failing companies are different. Corporate reconstruction in failing companies. Companies that are failing have major financial issues. Hence, in the short-term running, they could raise external finance to remain in the business. The existing creditors may be persuaded to get their repayments in alternate ways, so that debt can be cleared and company remains liquid. Options open to failing companies not wishing to go into liquidation, and which allow space for the development of recovery plans, usually include: Number 1. Company Voluntary Arrangement, CVA. Number 2. Administration Orders. Corporate reconstruction of solvent companies. The successful companies also undergo corporate reconstruction for the following reasons. Number 1. To improve the reputation of the company. Number 2. To improve the capital structure and gearing positions. Number 3. To reduce the net tax. Number 4. To improve financial security. There are 4 main types of reorganization used by solvent companies. Depending on the individual situation, these are: conversion of debt to equity, conversion of equity to debt, conversion of equity from one form to another, conversion of debt from one form to another. Number 1. Conversion of debt to equity. The common way of converting debt to equity is by the holders of convertible debentures, where at redemption, they can convert to equity shares. This helps the company in maintaining the liquidity as there's no outflow of money. The other reason for converting debt to equity is because if the short-term borrowing capacity has maxed out, then long-term debt must be made available. Long-term debt is more preferred than equity share because debt can be obtained at cheaper rate plus attract tax relief on it. Number 2. Conversion of equity to debt. Conversion of equity to debt mainly involves the conversion of preference shares to debt. In the eyes of company, the outflow is same as both preference share and debt requires a fixed return. But in eyes of tax laws, it is different as returns on preference share is dividends, and hence not tax deductible, while the return on debt is interest, which attracts tax relief. Number 3. Conversion of equity from one form to another. It was once common to have varieties of share capital, though it is not done anymore. The maximum that companies hold it 2 or 3 varieties. The purpose of doing it could be to make shares more attractive to investors. For example, by subdivision into smaller units or conversion into stock. Number 4. Conversion of debt from one form to another. One reason of conversion of debt to other forms would be because the capacity of borrowing from one source is maxed, and hence alternate sources taken. When companies have large short-term finances, they are replaced with more long-term finances as they are more permanent and flexible. Conversion of debts are also done because some sources of debts are cheaper than other. Therefore, this can reduce the overall cost of financing.